Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Many entrepreneurs from early stage companies make common mistakes that could be avoided when pitching to investors. Joining me is Richard Harroch, managing partner and global head of M&A at VantagePoint Capital Partners, Neel, Lilani, managing director of global corporate development at Orrick, and Kate O'Loughlin, director of tech and investment at Orrick, to discuss how entrepreneurs can improve investor interest and increase the likelihood of financing. I'd like to welcome everyone to the show. And our first question is, Neel, I'll kick it off with you. What issues are companies trying to fundraise? What are they seeing during this pandemic?
Yeah, thanks, Jill, and thanks for hosting us today. So a few things I'd like to call out. Fundraising during this environment is very different in that, you're not sitting down face to face with investors. Oftentimes, you're exclusively going through the process in a virtual environment. So that's obvious. That's an obvious difference. And how do you work around that? Building relationships, building rapport through digital means is super important, of course. But then, the question of diligence is a major concern. How are VCs going to diligence a company that they've never sat down and met with the entrepreneur around? So a couple of things, because of that sort of challenge of diligencing, you're seeing a bifurcation of capital, heavily focused on early stage, and then later stage where there's a bigger track record. That sort of middle, larger Series A, that's a more challenging environment where there is work to be done as far as diligencing is concerned, but there's less ability to do so virtually. Of course, there are sectors that are seeing increased attention. Anything that's sort of healthcare diagnostic that's virtual, cybersecurity with all of us working from home and other places that are not offices with robust, data infrastructure and security measures. And then, switching over to sort of evaluation and terms, we're seeing deals take longer. They're still happening. They are taking longer. We're seeing valuation sensitivity go up in this sort of interesting climate. And we're seeing, investors lean a little bit into writing earlier stage checks from the spectrum of their investment thesis.
Kate, what is the best way to reach out to prospective venture capital investors for your startup?
Yeah, I think there are 2 points to cover here. One is the who, so who are the right investors for your business? And the second is the how. How should you reach out and what are the mechanics? So I'll start with the who. Since COVID, there has been a shift for investors to be really transparent, more transparent than they had been, about who's actively investing in new companies now versus who is doubling down on existing portfolio companies. So identify those investors that are actually investing in new companies now. Once that's been done, then drill down to identify which investors are investing in not only your sector, but also your stage and your geography and location. And we'd also recommend exploring all options. For example, there are many new and existing funds that are focused on racial and gender equality. If you, your team, or your business speak to that, look into those funds. And as always, leverage your network. So your personal networks and your lawyers, your entrepreneurs, fellow entrepreneurs, advisors, and other investors. Warm introductions are like gold, or in this case, capital. And then the second piece is the how. So be thoughtful and concise when you're sending your initial outreach email to an investor. And what does that mean? What does that look like? We really recommend in the body of the email, having a concise 2 to 3 sentence description of your business, and then an attached deck. And a couple things on that. The deck, we really recommend limiting it to 10 to 15 slides. Recent report has shown that investors, especially early stage investors, spend no more than 3 minutes on a deck. So you want to make sure that you get all the information in just about 10 to 15 slides. And then make sure that the deck is actually attached to the email and that the investor doesn't have to go to another third-party source like a Dropbox or Box. And then one final recommendation is don't request an NDA at this initial outreach, because it's just going to create a barrier and obstacle to actually discussing and having a conversation with an investor. And at this point, you shouldn't be sharing any confidential information, and should assume that if you send a deck that it will be forwarded.
Yeah, and Kate, just coming off what you're saying, if there is something that's really secret sauce and substantive about that business, that'll come out during diligence anyway, right? So
That's
no need
right.
to share that, yeah, at the outset.
Now, Richard, you've been through hundreds of pitches. What should an investor pitch deck actually contain?
Well, the key slides of a pitch deck tend to be about 15 or 20 pages long. It really shouldn't be much more than that. Venture capitalists, investors often have a limited attention span. But the key pages, I think, for a successful pitch deck are first the company overview. It really should be the main first page that you pay attention to, where it tells me who the company is, where it's based, what sector it's in, you know, what key problem it's trying to solve, what technology it's been able to develop, and what traction the company has gotten. After that, I typically see in pitch decks the mission or vision of the company. Then I see a page on the team. You've got to convince me that this team is dedicated, it's experienced, it's, you know, it's really passionate about the business. Then the next page often is the problem page. What's the problem that this particular company is trying to solve? And is it a big enough problem that makes it interesting? The next page then would be the solution page. What's the solution that this particular company has come up with? And then I think a very key page is the market opportunity page. You've got to show me that there's a big market opportunity available to this company. If it's a small idea, I'm just not going to be interested as a venture capital investor. Then the next page should be the product page, describing in detail what the product's all about. Then the following page should be the customers. Who are the target customers? And then the technology page is really key. You've got to show me why this company has developed some interesting technology or is going to develop some interesting technology. The next page I expect to see is the competition page. You know, who are the company's competitors? What key features does this company have that makes it better than the competitors? Then the next page is a really crucial one for me, especially at early stages, and that's the traction page. What traction has the company gotten? Has it developed, you know, beta of its technology? Has it gotten some early customers? Has it done some pilot programs? Has it gotten some early buzz in the press? You know, show me what traction that the company has gotten, and it's not just an idea on a PowerPoint presentation. And then the last few slides that are important are a business model slide. How is this company going to make money? What's the marketing plan? You know, you've got to show me what the customer acquisition costs are going to be and how it's going to, the company's going to market successfully. And then I often, you know, jump to, when I'm reviewing a pitch deck, the financial and projections page. I have to see that this company within 3 or 4 years is going to be big. And for me, big means 20 million, 30 million, 50 million in revenues. Because if you show me projections that the company is going to be 5 million in revenues in 3 or 4 years, I'm just going to have no interest. It just isn't going to be big enough for me. And then the last page should be the ask page, which is, you know, you're telling me what you're trying to do. You're trying to raise $2 million. It's going to last you 12 to 18 months. It's going to result in being able to finish the development of the technology and get some early customers and get me to sufficient progress that I'll be able to raise the next round. So those are the key slides of the pitch deck.
Richard, you mentioned something around, you know, market sizing and, you know, making sure that it's a big enough opportunity to generate your interest from you. What about the other end of that? If you see an entrepreneur come to you and say that we're going to be at 400M ARR in the next 18 months, like, where is that sort of balance line for you? And what are those sort of red flags on the other end of that?
Well, the red flags are that if it's too small, I'm not going to be interested. And if it's too big, in fact, I had a pitch deck the other day come to me with projections that show they were going to be $438 million in revenues in 3 years. And that's just not realistic. And so it makes me question the management team that gives me projections like that. So I think it's got to be realistic. And I've got to see that the underlying assumptions make sense. So for example, if you're going to increase revenues by 200% over 2 years, I would expect that your marketing costs don't go up by only 10%. There's got to be, reasonable assumptions underlying this.
Yeah.
And Richard, equally as important, what mistakes do entrepreneurs make during the presentation of their pitch to investors?
Well, I think one of the first mistakes is that typically I will see a team, not just the CEO. And what I don't want to see is only the CEO talk. I want to probe and make sure they have a coherent marketing strategy. I want to make sure that they understand the potential risk of the business, and sometimes they don't. I want them to highlight their intellectual property. I want them to make sure that they're ready for the tough questions. So, oftentimes what I don't want to hear, one of the mistakes is I'll get back to you on that. You need to be prepared for the tough questions because you're going to get them. And in fact, you should welcome them. I mean, if you're getting questions, that means the investor is interested in what you're doing. And then at the end of the day, I've got to see some passion on the entrepreneurs. I've got to see the market opportunity be big. And if they're not showing me that, then that's a real mistake. And then back to the financial projections. If they aren't interesting, if they aren't reasonable, if they aren't big, but not, overly unrealistic, then, that's an important factor in my decision whether I'm going to invest or not. So those are some of the mistakes. There's lots of mistakes made, but those are the key ones.
And Richard, in your perspective, just a quick follow-up in your perspective, I think none of these mistakes will be make or break, but it's important to be aware of all of them. But it's just, is that right? Or
no, there is one mistake.
Okay, what's that?
And that is that you show me that the revenues within 3 or 4 or 5 years is going to be very small. I'm just not going to invest and take the risk in a company that tells me they're going to be $3 million in revenues in 5 years.
Great hobby, not in a VC investable company.
That's right. It might be a little business, but it's not a VC investable business.
Right.
So Kate, I want to throw it back to you. We know a pitch deck should be 10 to 15 pages. How long should the actual pitch last?
Yeah, so you can expect it to last between 30 and 60 minutes. And as Richard pointed out, if the investors are engaged and they're asking a lot of questions, that's a very good sign. So it may go a little bit longer. And just a couple of things to think about as you're preparing for the pitch in the 30 or 60 minutes, as we are in this virtual world now, just be sure to test everything in advance as you would with any other interview or presentation that you're doing. Practice really does make perfect in terms of the technology setup, but then also running through the deck with other advisors. And if you are doing a demo, which we really do recommend if you have that technology already developed, investors really do want to see the technology working. So we recommend doing a demo, incorporating that in your pitch, and also, of course, doing a dry run of the demo as well.
Yeah, these are all fantastic insights, not even just for pitch decks, but for all kinds of presentations. This is really helpful. And Neel, I want to wrap it up with you. When's the appropriate time to follow up after a pitch meeting?
Yeah, I think you want to follow up at the very least, within a couple of days of the pitch meeting. You want to be timely with it. And you don't only want to focus on the partners in the room. I think it's really important to make sure that you communicate your appreciation to the more junior members of the team, who are often going to be influential in, reminding those GPs of a particular deal, give it your deal or another. So it's important to develop those relationships and send thank you notes to everybody that was involved in the process.
All right, Neel, Richard, Kate, thanks so much for joining us on Trade Talks.
Thank you very much.
Thank you, Jill.
Thank you.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.